Hello everyone, a very good morning to you all. Welcome to the second lecture of Financial Management paper of ACCA. I hope all of you are doing well. We're going to be starting off from where we left off in the previous class. Let me open up the book. Good morning, good morning. So let's begin. So we talked about corporate objectives in our previous class as to what type of elements comprise the corporate objectives. Now we move our discussion to financial objectives. Okay. So financial objectives encompass targets for various metrics, including earnings per share, dividend per share, gearing level, and operating profitability. What are these? We will be learning them in special chapters. But, anyways, just to tell you in brief, earnings per share is what is your total profit divided by the number of shares. Okay. Then dividend per share is what? Total dividend divided by the number of share. Gearing level or debt to equity ratio is the proportion of debt in the capital structure of the company. And operating profitability is about the EBIT, the earnings before interest and tax of the company. So, the ultimate objective of financial management, always remember this, is maximization of shareholder wealth. Very, very important. Always remember this, maximization of shareholder wealth. This is the ultimate objective of financial management. The primary theoretical goal for a corporation, for that is for a company, is to maximize shareholder wealth. The company is working to increase the wealth of the shareholders, comprising dividends and share price growth. So when we say that the wealth of the shareholders is increasing, it refers to the growth in the share price and the dividends which are paid on the shares to the shareholders. So this is known as total shareholder return. So how can we understand whether wealth of shareholders is being created? By measuring total shareholder return. And what is total shareholder return? Closing share price, that is year-end share price, minus the share price at the start of the year, that is the opening share price, plus the dividend. This is the total gain which a shareholder has made out of the company's investment. And you divide it by the share price at start of the year multiplied with 100. This is the formula and you will have to remember it. But anyways, if you look at it closely, it's very practical. That what is the gain? So I invested 100 rupees in a company and by the end of the year, it becomes 120. For example, okay, so I invested 100 rupees and it becomes 120. So the gain is what? I've made a gain of 20. And how am I calculating that? Closing share price minus opening share price. On top of that, the company paid me a dividend of 5 rupees during the year. So the gain of 20, this is known as capital appreciation or capital gain or capital growth. Then plus dividend. Dividend is what? The amount that the company has paid to me during the year or maybe at the end of the year, whenever the amount which is paid to the shareholder. So that is dividend per share. This is the total gain in my investment of 100 rupees. 20 rupees plus 5, that is 25. So what is the total gain that I have made on the investment? 25 by 100%. Correct? So that is 25% gain. So in a publicly traded company, shareholder wealth rises with an increase in share price. This occurs when the company generates profits, distributing them as dividends, or reinvesting for future growth. Now, look at this statement. I'll elaborate on this further. Profits which a company makes can be distributed as dividend, or they can be reinvested in the business for future growth. Anyone who would like to elaborate on this? I would want to hear from you. What is your interpretation of this line? What is your interpretation of this line? Anyone wants to give it a try? Correct. So, remember, what are the three types of decisions that you have to make in the company? What was it? Investing decision, financing a decision, and dividend decision, right? These are the three types of decisions which we learned in the first class itself. Now, as a finance manager, it is your role. It is your role to decide how much of the profits that you're making should be distributed as dividend, that is, dividend decision, and the balance, how much of it should be reinvested in the business so that the company can take up further more projects. Okay, so that is what the statement means. Absolutely rightly said. So, whatever is retained in the business, that is reinvestment, and whatever is paid is the dividend. So profits, they belong to the shareholders, but they may be kept in the business or they may be distributed. That's the simple interpretation of this line. So this occurs when the company generates profits, comma, distributing them as dividends or reinvesting for future growth. Always remember this, profits have two purposes, either pay them as dividend or reinvest in the business. Provided the profits are earned without undue business or financial risk. I'll elaborate on this also a little further. It will all come in the chapters later, but let me just lay down the foundation for you. So what it says is, the profits are earned without undue business and financial risk. Why undue? Every business takes some risk. No business can run without risk. That is clear. But the risk shouldn't be undue. That means unusually high. So business risk means, I'll give you one example. The risk which is there because you are in a particular line of business. For example, ITC. ITC is in tobacco business. No. Shivani, this is not talking about that. Listen to me. Business risk arises because you are in a certain business. Example, ITC is tobacco business. Very recently, the Indian government announced that the GST on tobacco would be increased from 28% to 35%. I'm giving you a very relatable example, which you might have heard of if you keep yourself up to date with the business news. So you must have heard of it that the this GST was hiked from 28 to 35%. Did it affect all the companies equally? Every company in the universe in India? No, it only affected ITC and some other tobacco companies. So because ITC is in a certain business, that is tobacco, it got exposed to this higher taxation risk, and therefore there could be some drop in revenue, because when cigarettes become more expensive, it will be difficult for the company to sell them. Okay, so there can be some drop in volumes which the company can expect. Anyways, GST is an indirect tax. It is getting collected from the customer. Doesn't directly impact the company, but it could impact the company indirectly through the fall in number of customers who are going for it. So this is an example of business risk. Because a company is in a certain business, it gets exposed to all the applicable environmental aspects. Okay. So for example, one day comes and then India bans tobacco. Then also ITC gets affected. So it is exposed to business risk because it is in that business. That is business risk. Next is financial risk. Let's continue the example of ITC. So ITC is exposed to business risk, yes. Now ITC, I'm giving a hypothetical situation. ITC is financed by, let us say, 80% equity and 20% debt. Always remember, having debt in the capital structure is risky. Why? Because you are supposed to pay them fixed amount. Whether or not you earn money or not, whether or not you earn profit, you have to pay interest on debt. You have to repay the debt when the due date comes. Okay? So there are fixed obligations. What are there? Fixed obligations when it comes to debt. So if, for example, in a year, ITC makes losses, then, and it is not in a position to pay interest to its debt providers. Debt providers, they have the right to wind up the company. This element is known as financial risk. What is it? The risk in a business because of having debt in the capital structure, that is known as financial risk. Business risk arises because of being in a certain line of business. For example, ITC is a tobacco company. Anything which happens to the tobacco industry, it affects the company. Therefore, it is business risk. Okay, I'm repeating myself. Then, financial risk is the risk which arises because you have debt in the capital structure of the company. Because on debt, you have to make fixed obligation payments. Right? So, now with this, you read the statement with me again. This occurs when the company generates profits, distributing them as dividends or reinvesting for future growth, provided the profits are earned without undue business or financial risk. I hope it's completely clear, the entire statement. Maximizing share prices is commonly used as a proxy for maximizing shareholder wealth. So, the intent always is to increase the share prices of a company so that it grows the wealth of the shareholders, because any profit company is working with the objective to maximize shareholder wealth. Okay. So, maximizing shareholder wealth is justified for several reasons. Facilitates future growth. Companies delivering high returns attract more investment. So when you know that there is historically a good trend which this company displays, you want to put your money in that company. So companies delivering high returns to the shareholders attract further more investment, making it easier to secure new finance and foster, that is, promote future growth, contributing to optimal resource allocation and overall national wealth. So, when a company does well in rewarding its shareholders in the form of high returns, it becomes easy for such a company to raise further finance. Okay, so it facilitates future growth. Second is customer satisfaction and economic health. High investor returns often result from meeting customer demands, aligning with the nation's economic well being, as successful companies provide what customers need. See, you must have heard that customer is the king. You will be able to succeed in business only if are able to satisfy your customers. So, if a company is able to generate high investor returns, it is reflective of the fact that the company is be able to satisfy its customers through its offerings in the market. So, read this with me again. High investor returns often result from meeting customer demands, which also leads to economic development in the country. And third reason why, what are we studying? That why should you maximize shareholder wealth? Okay, so this is reason number one. Number two, then number three is underperforming companies are vulnerable to hostile takeovers. So if you're not performing, then you become subject, you become prey to hostile takeovers, emphasizing the importance of maximizing shareholder returns to deter such threats. Okay, so you have to be successful, otherwise, some other company will come and acquire your company. And then legal duty of directors, or you can say fiduciary duty of directors. Directors are legally obligated to manage companies in the best interest of the shareholders, assuming that shareholders, primarily institutional investors, they aim to maximize wealth. Why will a person invest in a company? To get maximization of wealth. Why do you invest? If any one of you are investing money in the markets, why do you do that? So that your wealth grows over time. So maybe you have invested 1 lakh rupees in the market today, and over time you will want that money to grow. And as directors, it is their duty to help you manage and grow wealth. Okay, so that is why the companies should focus on maximizing shareholder wealth. Now, I've got a doubt that, ma'am, what is hostile takeover? Hostile takeover means being taken over by some other company against your wishes. See, there are some very amicable negotiations which happen for takeover. Like, I am a company, and let's say you have a company. You want to take over my company. Okay, so we come across a negotiation table, discuss that, okay, you have to pay me this much money to get the shares of my company, and then you become the owners of my company. So that's a normal takeover, and it's also called mergers and acquisitions. Now, second aspect is hostile takeover. You come to me with an offer that, okay, we want to purchase the shares of your company and take over. But I'm not interested. I want to run the company as is. I don't want to sell the shares of my company. So what you do, you attempt hostile takeover. If the shares of my company are listed, you will want to acquire those shares. I'm giving you one of the ways in which hostile takeover takes place. There are some other ways also which will come later. But just to tell you in brief, it is hostile takeover means that being taken over against the wishes of the company. Okay. So when you try to maximize the shareholder wealth, that means the share prices increase, it becomes expensive for the other company to acquire your shares. And therefore, it deters, that means it pushes back the possibility of a hostile takeover. Okay, so underperforming companies are vulnerable to hostile takeovers because their shares are undervalued, emphasizing the importance of maximizing shareholder returns to deter such threats. Yes, takeover without the wishes of a company is called hostile takeover. When you maximize the wealth of the shareholders, then the shares in value increase, and therefore it is more difficult for any company to acquire those shares. That is what the third point is talking about. I hope it is clear, Parmi and Apurva, both of you. Yes? All right. All right. So, what have we covered? Why should the shareholder wealth be maximized? Then, critiques of maximizing shareholder wealth include, that means, why is there criticism against maximizing shareholder wealth? First, market imperfections oversight. So second, let me come to Excel to explain some of these points. Okay, let's cover it from here only. Critiques, as I told you, it is the criticism against the notion that okay, shareholders' wealth should be maximized. Number one is market imperfections oversight. Let's read it. Disregards market imperfections, allowing monopolies. What do you mean by a monopoly? Anyone? You must have heard this term before. What do you mean by a monopoly? Single what? So that means there is just one company that comprises the industry. That is, there are no competition, rightly said. Geo is not a monopoly. No. Give me some more example. Anyone wants to give it a try? Give me an example of a monopoly. Correct. IRCTC. There is no competition. Only IRCTC is running railways in our country. Right? All of you are right? So it allows monopolies to maximize returns, may lead to high consumer prices. So we see that how prices of railways have increased over time. Okay, contradicting public interest. So prices of the share price of IRCTC has also grown a lot. Let me just take you to Google once. So look at the 5-year graph of IRCTC from where it started off. Have a look here. 178 rupees in 2019, or maybe end of 2019, let's say 2020. 178 rupees in 2019 and over time, let's see where it has reached. Its peak was 1092 in 2021. Just a span of some 22 months. And it is giving almost 10x returns. 178, not on 10, almost 878x returns. So 1092. And now currently it is running at around 835. Okay, it has grown 368% over the past 5 years. So what does it show? That IRCTC is definitely rewarding its shareholders. Okay, so look at this. So how is the shareholding of Reliance? Mostly 62% is promoter. And who is promoter in IRCTC? The Indian government. So Indian government has definitely gained from its investment in IRCTC. Okay. It is holding 62% of IRCTC, and definitely it has grown the wealth of government. But in this way, it is also able to charge high prices. And of course, we keep hearing about complaints against the railway services. So, disregards market imperfections. This is a topic which will come later about markets imperfections. But just to tell you in brief that market imperfections, that means the market does not follow the theoretical, perfections, which are, for example, that the market is having competitive nature. Okay, the industry is competitive and all of that. So it disregards market imperfections, allowing, but don't stress on this much. We'll be covering this later in the syllabus. We have a topic on market perfection and imperfections, so we'll do that later. Allowing monopolies. Focus on this line now. Allowing monopolies to maximize returns may lead to higher consumer prices, contradicting public interest. So we see that in the pursuit of giving higher returns to the shareholders, IRCTC has increased its prices, and definitely it affects public interest. Then neglects social needs. Give me 1 second, please. Yeah. So, first point was what? Market imperfections, oversight. That means if you just aim or focus on maximizing the shareholders' wealth, then you are gonna disregard the market imperfections. Okay. So, as I told you, that it means market imperfections means what? So, in an ideal market, competition, when there is a competitive industry, competition ensures fair pricing and efficient delivery of services. However, in reality, there are imperfections like monopolies. And when monopolies aim to maximize shareholder wealth, they may exploit their market dominance by setting higher prices or reducing product quality, prioritizing profits over welfare of the consumers of society. So just break down this point for you here. Let's come to Excel. I will share across all of these files with you. These Excel files, whichever I'm displaying in the class, I'll share it with you. Don't worry. Don't have to write down anything on your own again. Clear? Okay. Now coming back. So this was market imperfections oversight. That means if there are imperfections in the market, like monopoly situation, in that case, this PDF is the VGLD book. You all would have got it now. I asked this earlier also, like, please get access to your VGLD book or reach out to Sandeep. This is the VGLD book which we are going to use in our classes. Okay. Okay, just reach out to Sandeep Apurva, no problem. Yeah. Just reach out to him and he will help you. Okay, so this is VGLD book that we are referring in the class. All right. Next point is criticism of maximizing shareholder wealth is that it fails to consider social needs such as health and education. You must be knowing how expensive healthcare is. in India, how expensive education is in India. What is happening in the pursuit of maximizing shareholder wealth? The companies charge higher prices. The companies charge higher prices, and therefore it leads to a, a failure to consider that these are social needs which are important for the growth of the society. Okay. Yeah, Kanika, we have changed the book this time. So we are considering VGLD book. You're right. We were considering another book earlier, and now we are considering VGLD book in the classes. Okay. So second is that high prices, it neglects social needs such as health and education. Third, stakeholder interests neglect. So maximizing TSR, that means total shareholder return, it may overlook the interest of other stakeholders like employees, customers, and society. I'll give you one example. To increase the profits of the company, the salaries of employees are being cut, or maybe employees are being laid off. So the pursuit of maximizing shareholder wealth, it may lead to an oversight of the interests of other important stakeholders. Maybe you are charging higher prices to the customer, or maybe you are increasing the credit period with the suppliers, or you're giving them very low prices for their products. So all of this shows that yes, in the pursuit of maximizing shareholder wealth, a company may overlook the interest of other important stakeholders. And unlisted companies variation, not applicable to unlisted companies where shareholders may not prioritize maximize returns, especially in closely held companies which are focused on owner prestige. So increase in the share price may not be the ultimate goal of an unlisted company, because there it is more about continuing the family business. It's more about the prestige of the owner. So that is what is written as a note here, that it is not applicable to unlisted companies. To maximize the profit, Apurva is asking, they can pay them less salary as compared to industry as per point 3. Yes, when you're not paying them enough salary just to save costs, that is a demerit which is resulting because of the pursuit of maximization of shareholder wealth. Okay. All right. So this is the benefit and the demerit of maximizing shareholder wealth. So it is justified for the following reasons. What are the reasons? It facilitates future growth, customer satisfaction, and economic health. Then hostile takeover deterrent. That means if your prices are properly, if your share prices are there high, then in that case, companies cannot overtake you without your consent. Then legal duty of directors, that is, it is the fiduciary duty of the directors to maximize the shareholder wealth. Now, there is some criticism of maximizing shareholder wealth, and what are they? Market imperfections, oversight. That means whenever there are market imperfections like monopolies, the objective of maximizing shareholder wealth, it leads to high consumer prices. It neglects social needs like education and healthcare. Stakeholder interests and neglect. That means other stakeholders' interests are neglected. And unlisted companies variation, that means it doesn't apply to unlisted companies where shareholders, they do not prioritize only maximizing returns, but it is more about the business continuity of a family owned business. Now let's do an example over here. An investor purchased 100 shares in ABC company at the beginning of 2010 at the market price of $10 per share. During the year, the investor received a dividend of $1.2 per share. At the end of 2010, the shares had an ex-dividend market value of $12.9 per share. Please tell me, what is the total shareholder return of this company? Everyone, please solve. All right, let's come to Excel to solve it. So, what is the share price at the beginning? Share price at the beginning is 10. So, investor purchased 100 shares at the beginning of at the market price of $10. So, this is $10. During the year, the investor received a dividend of $1.2 per share, and at the end, the share price has become 12.9. So 10 has become 12.9. That means there is a capital gain, as I was telling you. That is growth in share prices of 2.9. Dividend is of 1.2. Total shareholder return in value terms is 4.1. Okay. So total shareholder return is 41%. It comprises of two elements. It comprises of two elements. One is capital gain percentage, and this is called dividend yield. Basically 2.9 by 10 and 1.2 by 10. So this is the breakup of this 41%. It was not asked, I'm just telling you for your knowledge, that there is a capital gain yield, I can call this also yield, is of 29%, and the dividend yield is of 12%. Please tell me if it's clear to you all. Anyone having any queries? In value terms, the growth is of $4.1. Total shareholder return in dollars is 4.1. In percentage terms, it is 41%. Okay. Let me give you one more example to solve. Very simple. Give this a try. Giving you 2 minutes. A shareholder purchased 1,000 shares in SJG company on 1st January at a market price of 2.5. The share price at a market value of 2.82 per share. The dividend paid during the year was 0.28 per share. Calculate total shareholder return. Quickly, giving you 2 minutes. Everyone solve and let me know. Everyone, please do try, okay? Don't sit idle. All right, let's come to the solution part. I'll just copy it from here. So share price at the beginning is 2.5. This is 2.82. So the capital gain is 0.32. Dividend was 0.28. That is 0.6. So the total shareholder return is 24%. Okay. All right. Now, if I just take you back to the question we solved before this, there was a term called ex-dividend market value. It's a very commonly used term. You should be aware about it, so I'll explain it to you here in Excel. So there are two terms called cum dividends and ex-dividend share prices. Okay. So what is cum dividend? Cum dividend means this is the share price before the dividend payment is deducted. Investors who buy shares during this period are entitled to receive the upcoming dividend. Okay, so the share price, whenever, listen to me carefully, whenever a company announces dividend, the share price increases so that any person who is holding the share from before versus who wants to purchase the share now and get dividend, they are at parity. Okay, I'll explain it to you with examples. And then we have ex dividend. We have ex dividend. What does it mean? This is the share price. This is the share price after the dividend payment has been deducted. Investors who buy the shares during this period, they are not entitled to the upcoming dividend. Example. A company declares a dividend of dollar 2 per share. A company declares a dividend of $2 per share. The cum dividend share price, that means the share price which is there in the market is $50 per share. The cum dividend share price is $50 per share. Once the dividend is paid to the shareholders, holding the shares on the record date meaning, so whenever a company announces dividend, it announces a record date also. That is, this is the last date. If you're holding the shares of the company as on this date, then only you get the dividends. So once the dividend is paid to the shareholders holding the shares on the record date, the price typically drops. The share price drops by the amount of dividend. So can anyone tell me what would be the ex-dividend share price? Therefore, the ex-dividend share price would be dollar what? 48. So as and when the announcement happens about dividend, the share price increases. That means anyone who is holding the shares now will get the dividend. So up to the record date, the share price remains cum dividend. That means it includes the value of dividend. So anyone who is acquiring the share now, they have to pay a higher price because immediately after the record date, they will get a benefit of $2. So anyone who was holding the share from before and versus who is acquiring the share after getting to know the news of dividend, they are at same level. It is to ensure parity among the shareholders so that no one gets undue advantage. That the news comes of dividend and now I will purchase the share. So I will get a free benefit of dividend which others who are holding from before were getting. Okay. So this is an example. Now please let me know, is the concept of cum dividend and ex dividend share price is clear? Note, shareholder wealth or TSR in short. TSR is always calculated on ex dividend share price. Yes? Okay. Similarly, I'll cover some more concepts here. It will come handy to us later. Similarly, there is a concept called cum rights and X rights share prices. Similar concept, okay? Let's just build on similarly over here. So this is the share price before the rights issue. That means investors holding shares are entitled to subscribe to additional shares at a discounted price. You know what a rights share is? You know what is a rights share, anyone? No, no, no. Those are bonus shares, Kanika. I'm asking about rights shares. So I'll write it down in brief. A rights share is an additional share offered by a company to its existing shareholders, giving them the opportunity to buy more shares at a discounted price compared to the market price. That is a rights share. So a rights share is an additional share offered by a company to its existing shareholders, giving them the opportunity to buy more shares at a discounted price. Not free. Please be careful. It's not free. It's discounted price offering to the existing shareholders. Very good. Yes, you're right. Ishant, Padmi, Supratik, all of you have given the right explanation. I hope it is clear, everyone. Kanika, understood? These are not free shares. And all of you, whenever you are putting your answers in the chat, put it to everyone so that all of you can also read each other's answers. Okay? All right, so this is come rights. Now, this is the share price before the rights issue, similar to, here. This is the share price before the dividend payment is deducted. Investors holding shares are entitled to subscribe to additional shares at a discounted price during a rights issue. Okay? And similarly, what would be X rights? So this is the share price after the rights issue. The price usually adjusts downward to reflect the dilution caused by the issuance of additional shares. Okay. Example. Let's do one example. Example. A company announces a 1-for-4 rights issue. Can anyone tell me what this means? 1-for-4 rights issue. What does it mean? Think. Don't read any further. Just answer my question first. Absolutely right. 1-for-4 rights issue means that if you are holding 4 shares of the company now, you will get 1 share of the company at a discounted price. So 1 rights share for every 4 shares held in the company. Very good. All of you are telling me the right thing. So a company announces a 1-for-4 rights issue, meaning for every 4 shares held, you get 1 rights share, allowing shareholders to buy 1 share for every 4 shares they hold at $40. So this is the discounted price. While the come rights price is $50. Okay. So this is the come rights price. And they are getting one share for every 4 shares held at $40. So what would be the X rights price? How do I calculate the X rights price? It is gonna be 4 shares at 50, and anyone who acquires the shares now, they'll have to pay 4 shares to become eligible. Sorry, they will have to pay $50 to become eligible for the rights issue. So plus 1 into what? 40, and whole of this. How many shares will I now hold? Divided by 5. So the X rights price is 48. Take a look at it. So you will have to pay 50 rupees. And if you now hold 4 shares, you will get 1 share at 40. So divided by 50, sorry, divided by 5, that means the total number of shares that you're holding is the X rights price, dollar per share. Please tell me if the calculation is clear. Read through it. Let me know if it's fine. Absolutely right, Buddy. Yeah? Take a look at the calculation. Clear? All right. Now, I'll explain to you one similar concept again. I want to do it 3 of them together because they're all on similar lines. So there is come bonus and X bonus share price. Can anyone tell me what is a bonus share? What is a bonus share? Can anyone tell me? Absolutely right. This is free share. So these are the free shares. A bonus share is a free share issued by a company to its existing shareholders in proportion to their current shareholding. They are distributed from the company's accumulated profits. So bonus shares are distributed from the company's accumulated profits and do not involve any cash transaction from the shareholders. You're not giving anything to them in cash. You're just giving them accumulated profits in the form of free shares. And let me tell you, you will hear this term, that bonus share is also known as scrip dividend. Now you tell me, why would it be so? Bonus shares are also known as scrip dividend. What is dividend? Dividend is distribution, or you can say normally when we say dividend, it is cash dividend. So normal dividend is distribution of profits of the company as cash to the shareholders. Bonus shares are also a form of dividend only. Instead of cash, you are giving shareholders free shares. Is it okay? Are you able to follow me? So bonus share is a free share issued by the company to its existing shareholders in proportion to their current shareholding. Bonus shares are distributed from the company's accumulated profits and do not involve any cash transaction from the shareholders. They are also known as scrip dividend. Now let me explain to you. I hope this is clear. Everyone, please confirm. The explanation of bonus shares. It is a free share. Free share issued by a company to its existing shareholders. Yeah. Now, what is cum bonus and ex bonus share price? I'll just copy this again. Cum bonus and ex bonus. Same definition. This is the share price before the bonus shares are issued. Investors holding shares during this period are entitled to receive the bonus shares. And what is ex bonus share price? This is the share price. After the bonus shares are issued, the price is adjusted downward to reflect the increased number of shares. So example. A company announces a 1-for-2 bonus issue. Okay. Cum bonus. Cum bonus price is $90 per share. Cum bonus price is $90 per share. So this is $90 and the company is announcing a 1-for-2 bonus share. It means what? That for every 2 shares held, the shareholder will get 1 free share. Absolutely right, Anil. So can I say ex bonus price is what? It will be what? Similar formula let's apply here, but instead of, so this is 90 into 2, but I'm not gonna get any price. I don't have to pay any price, so I can say 0 into 1. I'm applying the same formula which I used here. I'll just copy paste this and change the numbers so that you understand better. So this is 2 into 90 plus 1 into 0 because I don't have to pay any price, divided by 3. So the X bonus price is $60 per share. Got it? Everyone, please confirm if the calculation is clear to you all. Take a moment, no hurry. Let me know whenever you're done. Clear? Yes. All right. So very, very important concept of cum dividend, ex dividend, In the same way, we have discussed all the concepts. Come dividend, ex dividend, then come rights and ex rights, and come bonus and ex bonus share price. Okay. Now, on that note, let's come back. So I'll give you one question for practice. Okay. Read it very, very carefully. It's a theory type of a question, but involves numbers. B company has just released its financial results for the year and its profits before tax increased by 38% over the previous year. This was due largely to a doubling of sales in Southeast Asia. However, the share price in B company fell by almost 20% immediately after the profit announcement required. Which of the following is the least likely explanation? That means which is not the reason for the fall in share price. I'm giving you 2 minutes. Think about it. Tell me which one is the right option. Okay? Solve and let me know. Okay, so all of you telling me option B is correct. Ishan tells me option A. Okay, mostly towards option B. Others, what about you? Tell me. All right. So let's read the option. Yeah. So sales in Southeast Asia had been expected to increase by more than 100%. So it is the shareholders' expectation on the basis of the performance of the company that the increase will be more than 100%. So currently it has doubled. That means it has increased by exactly 100%. But the expectation was that it will increase by more than 100%. Okay? So for example, let me explain it to you with numbers here. Option A. I'm taking random numbers here. So actual performance, sales in previous year was 200, sales in current year is 400. So what is the percentage increase? 400 by 200 minus 1. That means there is a 100% increase. Expected performance, however, was that okay, sales in previous year was 200, but the shareholders expected that the sales in current year would be 520. That means the increase would be 160%. These are random numbers, don't think from where they are coming. So just to tell you that actual performance, it doubled. Yes, it became from 200 to 400, but the expectation was that it will grow more than double. Since the growth in sales is less than the expectation, this would negatively impact the shareholders' perspective towards the company. Hence, the share price could fall due to this reason. This is the explanation for the first point. Okay. Then, the depreciation charge was higher due to a change in accounting policy. Okay, can the share price fall because of change in accounting policy? No. Shareholders know that this is just an allocation. Always remember that depreciation is a systematic allocation. I'll write it down. Depreciation is a systematic allocation of cost of an asset over its useful life. So, whatever method you may follow, the cost is just getting allocated over the years. It's not going to change your profits as much because the cost has already been incurred. Depreciation is just a systematic allocation of that cost over the years. So, change in change in accounting policy. So, change in accounting policy for charging depreciation will not, is least likely to cause a fall in the share price. But it will do so in any year. Think about it, Shivani. The total cost is same. Whatever, so let's say under one policy, okay, everyone listen to me carefully. Let me show you with example, this one also. So let's say, example, again, imaginary numbers. Cost of the asset is 2000. Okay. Earlier, the depreciation was being charged on, let's say, WDV basis. WDV method at the rate of 20%. And useful life is 5 years. Okay. So opening balance is 2000. This is the cost of the asset for year one. How much depreciation will be charged? 2000 into 20%. 1600 is the closing balance. And this 1600 becomes the opening balance. Okay. Every year, you're going to charge depreciation like this. And in the last year, you have a balance of 819. Since the useful life is 5 years and you're going to scrap it off at the end of it, whatever is the balance in the asset account, it will be charged off. Again, a new concept. At the end of the useful life of the asset, the balance in asset account is charged off to the P&L as balancing whatever is the balance, it gets charged off to the P&L. It's called balancing charge. So if you see, the total depreciation that has been charged is 2000. Okay. Now, yes, depreciation is a tax allowable expense, but the tax that is going to save total, let's say the total tax rate is 30%. The total tax it will save across in 5 years will be what? 30% of 2000? The total tax saved due to depreciation, yes. It saves tax, but what is the total tax that is getting saved? It is 600, correct? Now let us say the company changes the method. The company changes the method of depreciation to straight line method. That is SL. So what will be the table looking like? Opening balance is same, 2000. And now the depreciation will be 2000 by the useful life, which is 5 years. And every year the same depreciation will be charged. That is what straight line means. So if you see the total depreciation that is getting charged is what? 2000. The total tax it will save will be what? 600. So this is what it shows, that profit does not get impacted. If you see overall, the same depreciation is going to get charged to the P&L. It's just that the amount is getting changed within the years, but total is same, and therefore the change in the method of charging depreciation does not affect the share price, because shareholders are also smart enough to know that depreciation is simply an allocation of the cost over its useful life. Okay. So changing the method will not lead to a fall in the share price. Now, please let me know if it is clear with this example. Shivani, Apurva. Clear? 600. What is 600? 600 is the tax saved. So one of you had raised the concern that depreciation saves tax. So I'm assuming that the 30% tax rate is there. Under this method also it saves 30%. I mean, it saves $600 of taxes. Here also it saves $600 of taxes. It's just tax. Okay. All right. So I'm deleting this part not to confuse you. So the total amount which is getting charged off to the PNL is same, whichever method you may follow. Okay. All right. Now, next option was what? The level of B company's business risk has increased. So definitely increase in business risk can lead to a fall in the share price. So shareholders must be afraid of the increase in business risk, and therefore the share price can fall. And delays in the launch of new products are expected in the coming year. So if a project is going to get delayed, then the profits which are going to generate out of that project will also get delayed. So therefore, D can definitely lead to a fall in the share price. Yes. So the correct answer, which one of them is least likely the reason for fall in share price? The answer is change in depreciation policy. Okay. So on that note, let's take a break here. We'll break for 10 minutes and then continue post the break. Refresh yourself and be back. So, Mohit, class timings are 7 a.m. to 9:30. And Apurva says, like workbook, is there any practice kit by VGLD or we're going to follow BPP and Kaplan for question? No, there is, okay, let me just show you here in the book only. There are a lot of questions for practice here. So if you see, the book is of in two parts. First is the main content, chapter-wise content, and then question and answers are there, chapter-wise. So from 205 till the end of the book, around which is up to 500 pages, 300 pages of total questions are there at the back of the book. So we're going to practice from here. The content will be covered from here, and of course, we will be discussing some extra questions in class also. Okay, Apurva, so you don't need to follow any other book. This book will be comprehensive. Okay, all right. So now we did this and okay. So companies often struggle to adhere to the theoretical goal of maximizing TSR due to market influence on share price. Listed companies frequently experience share prices influenced more by overall market conditions than their individual performance. So the share prices they tend to get influenced by the market phenomena. Then unlisted companies lack of share price. Unlisted companies lack of a quoted share price, making it challenging to maximize as a benchmark. So it's very difficult to maximize the share price of an unlisted company. Okay. Hence, profit maximization is often used as a substitute for shareholder wealth maximization. Okay, in cases where wealth maximization cannot be measured accurately, profit maximization is done. So, however, profit has some limitations. Number one is equity cash generation link. Company equity is more tied to cash generation rather than accrual based accounting profits. Then it means that profit is not same as cash, and therefore the value of the company which is more dependent on cash generation, profit is not the right benchmark for valuing a company. Then short term focus risk. Pursuing short term profits may sacrifice long term growth, such as cutting investment in research and training. So, just to increase your profitability in the short term, the company may resort to practices like cutting down the investments in research and training, and that may not be a good idea in the long term. Then, third is manipulation and fraud risks. Pressure to maximize profits can lead to data manipulation and, in extreme cases, fraudulent accounting also. See, accounting profits, they are subject to a lot of judgments in a lot of areas, and therefore it may be subject to manipulation, and therefore there is a risk of using profits for valuing a company. And then debt financing impact. Accounting profit includes debt financing cost but not equity financing cost, incentivizing companies to use zero debt for maximum reported profit at the cost of losing tax benefits. Always remember, interest on debt is a tax deductible expenditure, and therefore, it's called that if you're using debt, it means you're gonna be able to save taxes. We're gonna learn about all of this in later chapters, but anyways, just to tell you that debt saves taxes, whereas equity doesn't. Dividends are not tax deductible. So, because in accounting profit, you deduct interest, but you do not have any charge for equity. Okay. So companies are more focused on increasing the use of equity if you're using profit as a benchmark for valuation of a company. Okay, so very simple points. Now, the next topic that we have here is EPS. What is EPS? Profit after tax minus preference dividends divided by weighted average number of shares in practice, or you can simply say number of shares. So if preference shares have been classified, one second. Yeah. So note, if preference shares have been classified as non-current liabilities, then preference dividend would be included in finance costs and therefore already deducted from profit. So if under accounting principles, you are classifying preference shares as liabilities, then you don't need to deduct it further over here. It would have already been deducted while calculating the profits. So EPS growth is crucial for analysts advising investors in listed companies with regular publication of quarterly forecasts for insights into financial performance and investment potential. So EPS is a very important metric which is closely tracked by investors. This creates pressure on management to meet analysts' expectations. So are you seeing that EPS is a measure which is based on profits? So this creates pressure on management to meet analysts' expectations, and as EPS is based on accounting profits, it shares the above mentioned problems like manipulation. Furthermore, EPS can be artificially increased through a share consolidation. That means if the number of shares in the company are reduced due to share consolidation process, then EPS can be artificially increased, because if the number of shares reduce, the resultant value of EPS, which is what? Profit divided by number of shares, that will increase. Then legitimate increases may occur through a share buyback scheme, although research suggests, meaning what? So if you're buying back the shares, your number of shares will come down. So, although research suggests that directors often use it for personal gain, benefiting from a rise in share prices after the announcement. So, I'll tell you a few things here. Let's come to Excel. And I'll tell you one very important thing, a very important resource for you, which I have created. Let me present that. So, this is a formula sheet which I will be sharing across with you. And I've compiled all the formula, very simplest of simplest formula and some complicated formula also, which you're going to learn as a part of your syllabus in this sheet. And I'll tell you, it has helped so many students. See, just today we were doing this now. X rights prize. You did it logically in your mind. But here I have put it down for you. Okay. So every formula that you're gonna need in your FM syllabus, see, it's a long, long list. It doesn't mean you have to memorize so much. Don't think like that. It's just a lot of basic conceptual things also I've tried to summarize here in this list for you. So as we progress into the syllabus, I will keep highlighting those line items which we are covering. So total shareholder return we have covered today, right? We broke it down in capital yield and dividend yield. So this is done. So I'll just highlight that, okay, this is covered in the class. Then yes, so PM also we have the same thing, right, Apurva? And it's been very helpful for the students because just before the exam, and I'll tell you so many simple marks you can score out of it, because in section A and B there are common questions, calculate TSR, calculate whatever these small things which you're going to learn, and it helps you score a lot of marks. Okay, just before the day of exam. It will help you a lot. Okay. All right. So EPS, see, EPS also it is covered here. It is what? Profit by number of shares. Okay. That is profit attributable to equity shareholder divided by number of shares. So all the ratios that we're going to cover in the class, it will be here, and I'll share across this file with you. So there are some other sheets also which we will cover slowly and gradually. We have already covered this part, rounding off, right? There are some other things which I will discuss with you over time, and we will do it. Okay, coming back to this point, EPS. Okay. So what it is saying is that, what's the formula? First of all, the formula is EPS is equals to PAT by number of shares. If the number of shares reduce, if the number of shares reduce, EPS will increase. Correct? Basic maths. If you reduce the denominator, the resultant value, EPS will increase. So directors may try to artificially increase the EPS by number one, share consolidation. Ma'am, what is share consolidation? Reduction in the number of shares by increasing the, that is, reduction in the number of shares by increasing the nominal value per share. So earlier, say we were having 100 or 1 lakh, 1 lakh shares at the rate of, the nominal value was at the rate $10 per share, will be reduced, are reduced due to consolidation as follows. So the nominal value total won't change. I mean, I am reducing the number of shares to 50,000. So what will be the nominal value, revised nominal value? And it's just the book value of the share. So nominal value will be what? It will become double. So in this case, EPS will be increased. Please tell me if you're able to follow, not follow. Let me know, please. Yeah. Or share buyback. Or they may do share buyback. That is purchase of the shares of the company. So in which a company buys back its own shares from the shareholders. That is purchase of the own shares or buyback of the own share, purchase of the own shares back from the shareholders. That is share buyback. Okay. So there were 1 lakh shares at $10. They are reduced due to buyback as follows. So let's say now it has become 80,000. 20,000 were bought back. The nominal value does not change. The nominal value will not change. 1 lakh shares at $10 per share, they are reduced. So in this case also, EPS will get increased. Clear? So these are the tactics. These are the tactics which directors may engage in just to increase the EPS. Coming back. So this is what was covered here. Share consolidation and share buyback scheme. I've given it to you with examples. Why will shareholders agree to a share consolidation? So share consolidation, it doesn't affect the shareholders actually. If you think about it, share consolidation is just changing the nominal value of the share. So it doesn't affect the shareholders. So earlier, what will happen? Earlier they were holding 1 lakh shares, okay, of $10 per share nominal value. And then what will happen in share consolidation? They will take back these $1 lakh shares of $10, so the share certificates, they will take it back and fresh issue of share certificates will happen of 50,000 shares at $20 per share. So it's a common practice. It doesn't affect the shareholders at all. The total value is remaining the same. So they do not get, they do not, it doesn't affect them. Okay. It's primarily, if you just look at it, it's just a restructuring tool. You're restructuring your balance sheet. That is what it is. It doesn't have any financial impact. Okay. It's not reverse of bonus issue. No, no. Bonus issue is a gain which the shareholders make. Here, the shareholders are not making any gain, any loss. Their situation remains the same. What it was before, it continues to remain the same. It is not the reverse of bonus issue. In bonus issue, you are issuing new shares. Bonus issue is a new issuance of share which is given to the shareholders. Here, no new issuance is happening. It's just that old shares are cancelled and new shares are issued in its place. So it's just a replacement that is happening. No new issuance. Got it? Okay, Apurva says EPS and TSR are related. Like, can you explain a bit of EPS? I don't understand EPS clearly. EPS, it's just a simple calculation that, okay, you made earnings, you made profits. If you look at it, TSR is linked to share prices. Okay, TSR is linked to share prices, whereas EPS is linked to profit. So EPS as a measure is that, okay, on a per share basis, how much the company has made profits. Whereas TSR is what is the gain. I'll just go back here. Here. Yeah. So TSR is what is the growth in the share price and what is the dividend total gain in value terms, what has come to the shareholders. That means if you sell the shares today, you invested 2.5. If you sell the shares today, you're going to get 2.82 plus you have already earned the dividend. So you have made a gain of 0.6. This is the wealth which has come to the shareholders in monetary form, in visual form. Whereas profit is just an accounting measure. So profit per share or EPS per share is also simply an accounting measure that, okay, the company is having so much EPS. Okay. All right. Understood, Apurva? Clear. Now, Shivani says that the number of shares are decreased. Okay, Shivani. So let's do one thing. I give you, so let's take a simple example. I've got 5 Lays, 10 Lays at Lays chips, okay? 10 Lay's packets at rupees 20 per packet. Okay, I give this to you. Excel is not showing. Okay, sorry. Yeah. So 10 Lay's, I give, Shivani, give 10 Lay's of 20 rupees per packet to you. Okay. And you tell me, ma'am, okay, you have given me 10 Lay's. I am giving you 20 Lay's. Let's say the grammage of each packet is proportionate. So I am giving you 20 Lay's packet of 10 rupees per packet. Now tell me, has anything changed? So you went to the shopkeeper, or let's say you exchanged it with me only. So Shivani to Anushka. And Anushka to Shivani. Tell me, is there any change in our wealth? Let's say we are talking in terms of money. Has anything changed between you and me? I was already having 10 Lays at 20 rupees per packet. You are already having 20 Lays at 10 rupees per packet. I just exchanged it with you. So there is no change. Although if you see, the numbers are different, double and half. So quantity changed. So what? I'm getting the same value. Quantity has changed and therefore my EPS gets affected. EPS gets affected because of the change in the number of shares. But if you look from the point of view of the wealth of the investors, no impact. I was earlier having 20 Lays of 10, I mean, maybe what, 20, yeah. I was having 20 Lays of 10 rupees per packet. Now you took that from me and you gave me 10 Lays packets of 20 rupees per packet. So my and your wealth, it remains the same. And that is what is happening in case of investors also. Earlier, they were holding 1 lakh shares. The company took it back. The company took that 1 lakh shares back and they gave them 50,000 shares, but the price was also doubled. So that is exactly what is happening between an investor and the company, what is happening between you and me in this example. Okay? All right. So on that note, let's come back here. So this part we have covered. Now let's do a very simple example here. Take a look. During the year ended 31st March 2015, George Company reported EPS of 10.3 cents. Cents meaning what? 100 cents make up a dollar. Okay. 100 cents make up a dollar. The company had 400,000 shares in issue at 31st March 2015. On 1st October 15, George Company issued 60,000 shares at the market price. Profit after tax for the year ended was 57,000. There was no preference dividend. Okay. Now I'll just take it back here. This is the data in the question. You have to tell me what is the growth in the EPS. You have to calculate and tell me what is the, okay, sorry. What is the growth in the EPS? There has been an issuance of shares. So take 5 minutes. Take 2 to 5 minutes. Please solve and share your answer to example 2 here. Let me know whenever you're done. Everyone, please do try. Do not sit idle, okay? Just simple question, solve it and let me know. EPS you should always give in dollar terms. Don't put it in percentage, although it's okay to put it, but normally it is recommended that you give it in dollar terms. Okay, so Pratik and Kanika check the calculations, but just generally remember that EPS, try to quote it in terms of dollar, that whatever it is. Like if the share value is $10, so EPS it is said that okay, it is $1 per share. So like that. Okay. All right. So you need some more time. I've just seen a few answers. I'll wait for a minute more. Please solve and let me know. Please do try, don't sit idle, okay? All right, so variety of answers. Let's check what is correct. Welcome to Excel. So, number of shares, what was the starting date? Number of shares as on 1st April 2015 is 400,000. 400,000. Number of shares issued on 1st October 2015 is 60,000. Okay, so calculation of weighted average number of shares, opening shares, issued shares, number 60,000, number of months outstanding. 12 and 6. So this is your X. This is your weight. So weighted average, how do we calculate? Done. So then it's 2000. Sorry, this will be, this is active for the whole year. So this is 1, whereas this is active for just 6 months, right? So 6 by 12. So the weighted number of shares is 4,30,000. So weighted number of shares is 4,30,000. So this is active for number of years, you can put it. Number of year outstanding. This is outstanding for whole 1 year. 4 lakh number of shares were outstanding for the whole year. And this is outstanding for 6 months of the year. So the weighted number of shares is 4,30,000. Okay. And now, what were my profits? Profits were 50,000. So profits after tax, PAT is $57,000. And therefore, EPS will be 57,000 by 4,50,000. That is $0.13 per share. This is in dollar terms. Okay. EPS as on, this is EPS as on 31st March 2016. And EPS for the year ended 2015 was how much? It was given in the question as 10.3 cents. So I told you 10.3 cents, meaning divided by $100, that is 0.103. So EPS or growth in EPS, if you ask, is how much? 28.7%. Growth in EPS is 28.7. Please go through it. Let me know if it's fine. here. All right. So the answer is final answer that you would have to put in the answer box would be 28.7%. A lot of the times they put the percentage outside the box. So in the box, you will put 28.7. So be careful about that. Yeah, previous year end EPS is $10, no? 10.3. And EPS for the year will be 0.13. Okay, that was for the previous year. See, I've written it here. EPS for the previous year was 0.103 and now it is 0.13. Just what you have to do is find out the weighted average number of shares. 4 lakh shares were outstanding for the whole year. 60,000 shares were issued during the year. So they were outstanding for 6 months, or you can say 0.5 years. So that is 30,000. So the total number of weighted average number of shares is 4 lakh 30. Do not take it as 4 lakh 60,000 because 60,000 shares were issued in the middle of the year. Okay. How did 13% came? So this is profit divided by the weighted average number of shares. So the formula of EPS is PAT by weighted number of shares. So that's what I've done over here. PAT, it was given in the question, divided by weighted average number of shares. Okay. So this is 57 by 4,30,000. And earlier it was 0.1. So the growth is 0.13 by 0.1 minus. This is your answer. Please confirm everyone if it is fine. Any doubt, let me know. Sub 1. Ma'am, why we? Oh, so what you can do is, to find out growth, what can you do? 0.13 minus 0.1. Okay. So you find 0.03 is the growth. And then 0.03 over this 10 cents. This is how you can find out growth. Okay. I'll just link it properly. One way to find out growth is this. Okay, 0.13 by minus 0.103. You get the growth like this, right? This is how you calculate growth. So instead of doing two things, instead of doing first 0.13 minus, can I write it like this? 0.103 whole of it divided by 0.103. Can I write it like this, Shivani? Yes. Can I then write it like this also? 0.13 by 0.103 minus 0.103 by 0.103. Can I break it down like this? Basic maths. I'll just put brackets here. Same. Can I therefore say it is nothing but this minus 1? That is what I've done over here. See, 0.13 by 0.103 minus 1. So instead of going this long way, I've just done it simply. I'll keep it as a self note here. I hope it is clear now, everyone. Please confirm. Yes. All right. So on that note, we'll pause here and we'll continue on Thursday. Thank you so much for joining in. Have a good day ahead. Take care of yourselves. Bye-bye. Thank you. I'll share it. So the class notes are shared after chapter completion. Once the chapter is complete, I'll share across the notes. Okay, Varsha? So that any update, it can get incorporated and you get the final version. All right. Thank you. Bye bye.